Well, hello, everyone, and thank you for joining today's webinar with how to set up a trading business in 2018. This is Cynthia Tomain with Interactive Brokers, and we're very pleased that you've joined us today. And I do also want to introduce Robert Green, CPA and CEO of GreenTraderTax.com. Robert has been doing multiple different webinars with Interactive Brokers, and all of his recordings are also available on the Interactive Broker website. But let's get underway here today, and we'll get started. Now, Robert, thank you for joining us. I'm going to go ahead and make you the presenter. So if you can start or share your screen, we'll go ahead and get underway. Ah, beautiful. I see it. Full screen or full. There you go. You're getting it into slideshow view. There we are. Okay, looks great. Take it away, Robert. Thank you.
Thank you very much, Cynthia. Thank you, everyone, for joining us today. And let's get started. How to set up a trading business in 2018. It's still early enough in the year to do that. I'm the presenter, Robert A. Green, CPA, managing member of G&M TraderTax. That's Green, Neuschwander, and Manning, LLC, our CPA firm, and Green TraderTax, our publishing and content company. I'm considered a leading authority on trader tax. Author of Green's 2018 Trader Tax Guide, published every year, updated since 1997. The latest edition includes the Tax Cuts and Jobs Act's impact on investors, traders, and investment managers. I'm also a contributor to Forbes.com, and you'll find our content on leading brokerage firms like Interactive Brokers and other financial media. And you'll see me at the Traders Expo. You just saw me last month. This information is educational. It's not intended to be a substitute for individualized tax, legal, or investment planning advice. You should get that type of advice from a competent professional. I, Robert Green, and the Green Companies are not affiliated with Interactive Brokers. They're a brokerage firm, we're a CPA firm, and a tax publisher. Today's agenda is I will explain how an active trader can structure a trading business to maximize tax benefits, especially under the Tax Cuts and Jobs Act, which made a lot of changes. And a lot of business people are nervous about that. They want to get with their accountants and tax attorneys to be sure they're set up in the best manner possible, not to leave any tax benefits on the table. So we're going to learn the advantages. You're going to learn the advantages of and challenges of sole proprietorships, that's unincorporated businesses, general partnerships, LLCs, S-Corps, and C Corps. We're going to cover the gamut. The key point, the linchpin for all the benefits as a business is trader tax status. A retail trader trading your own funds must qualify for trader tax status, TTS, to enjoy the business-related tax breaks. Why is that important? Because investor tax status has limitations, which have been exacerbated under the new tax law. So by default, when the IRS looks at you, they consider traders to have investor tax status, not trader tax status. They think you're an ordinary investor with capital loss treatment and wash sale loss limitations. For 2017, get it while you can, investors may deduct investment expenses as miscellaneous itemized deductions. That's if you're itemizing and not taking a standard deduction, only if it's more than 2% of adjusted gross income. And then it's not even deductible for AMT. And a lot of items are not even included. So you used to get some crumbs. Now you get nothing as an investor. For 2018, the Tax Cuts and Jobs Act suspended all miscellaneous itemized deductions, including investment expenses. So you get no deductions, and investors cannot deduct health insurance premiums and retirement plan contributions related to portfolio income. If you have another source of earned income, it's different. Now, let's say you say, okay, Bob, I'm going to do an end run around the IRS. I'm going to set up a company. I'm going to set up an LLC, and that's going to be my ticket to business expenses. No, it's not. partnerships and S-Corps with investor tax status pass through investment expenses to owners. They don't pass through business expense treatment. You're back to square one with a suspended deduction. Now, trading investment partnerships also may not elect 475 mark-to-market accounting ordinary income to qualify for the new 20% pass-through deduction that we read about in the new tax law. And so you can't set up the company for the 475 election because you need trader tax status for that. And so you're not going to be able to get the health insurance and retirement plan deductions with an investment company. So the investment company doesn't do anything for you. The C Corp is also not a solution for you if you're an investment company, because guess what? If your C Corp is an investment company, you can't deduct any expenses. That's even under the old law. And the IRS won't allow you to keep any retained earnings. They're going to hit you with a 20% accumulated earnings tax. So the message is trader tax status is critical to a trading business and entity. You can deduct business expenses from gross income through a sole proprietorship, partnership, or S-Corp across the board, even a C Corp. If you have trader tax status, you stamped your ticket to being able to deduct business expenses. No elections required. You can assess it after the fact and deduct business expenses. Now, you also are permitted to file a timely Section 475 election for exemption from capital loss limitations and war sale loss adjustments on securities, the so-called tax loss insurance, and to be eligible for the 20% pass-through deduction on qualified business income. So this election deadline is in 2 days for a partnership or an S-Corp. It's March 15th. It's coming up on April 17th for individuals or C Corps. So focus like a laser on this content today. You may be rushing to make both an S-Corp election in 2 days and a 475 election in 2 days if you want to cover the gamut of tax breaks from the takeaway of today's session. Now, you can, if you have trader tax status, you can form an S-Corp trading entity or C Corp management company to unlock the employee benefit plan deductions, including health insurance and a high deductible retirement plan. Your sole proprietorship and partnership get all the business deductions and they can make the 475 election, but they can't do the employee benefit plan deductions. For that, you need the S-Corp trading company and or the C Corp management company. Now, I've mentioned how trader tax status is the linchpin. It's not so easy to just get that ticket, that green light to all these benefits. And you certainly don't want to have the tax tail wag the dog. You know, I'm not telling someone who trades a few times a week and does very well doing it to step on the gas and trade helter-skelter just to have more trades for trader tax status. But if you do qualify, you should know it and get the benefits from it. So the IRS recognizes trader tax status, TTS, but it does not provide a bright line test for qualification. That's where I come in with my golden rules for qualification, which I base on extensive analysis of trader tax court cases and dozens of years of experience preparing tax returns for traders around the country. So I'll give you those golden rules at the end of the session today, time permitting. Otherwise, you can always get them in the download of the PowerPoint presentation on the IB site. So if you qualify for TTS as a sole proprietor, partnership, S-Corp, or C Corp, you're going to be in luck. So let's first talk about a sole proprietor. That's an unincorporated business. That's an individual who happens to be in business. You can claim TTS on a Schedule C for 2017. You're preparing your 017 taxes now. You started TTS in Q4, Q3, Q2, Q1. You can add a Schedule C for that period of the year for your business expenses and have a Section 195 startup cost to go further back. You can do that for the past, even the open past 3 years. But now for 2018 going forward, we can think about a different type of entity. So year to date, 2018, from January until now, you've been an individual, maybe with trader tax status. And now maybe we'll set up an entity for the rest of the year. So here's what you can do as a sole proprietor. Plenty. More than half our clients have been sole proprietors over the years and done very well with it. Not everybody needs an entity for employee benefit plan deductions and some of these other breaks because they have them otherwise in their life. Or they're not paying for health insurance. They don't even need it, or they don't want a retirement plan. So a lot of you fit into this category. Sole proprietor business expenses and a 475 election opportunity. Many active traders ramp up into qualification for TTS. They wind up filing an individual Schedule C profit or loss from business as a sole proprietor business trader the first year. That's fine. Or several years. Deduct trading business expenses on Schedule C and report trading gains and losses on other forms. Your home office expenses will wind up on Schedule C too. There's a way to unlock the home office expenses by pointing to the trading gains because they require income. The home office expense portion, except for the interest and real estate tax portion, is allowed even with losses. And if you have losses, you're allowed all the business expenses on Schedule C. And you as a sole proprietor, right now, today, focus, you need to consider filing a 2018 Section 475 mark-to-market accounting election, MTM election, by April 17, 2018 as an individual, March 15th as an existing partnership or S-Corp, so you can have ordinary gain or loss treatment. We recommend it on securities traders. There's 3 new blog posts, one on entity extensions, one on individual extensions, one on the 475 election. Come to our website to read those. You want that tax loss insurance. If you have a big loss year to date and you're stuck with a capital loss limitation, simply by electing 475, you can turn that into a business ordinary loss to offset against your wages, your spouse's wages, any of your other income. Would have an NOL carry forward. So that's a very powerful election. You're entitled to make it as a sole proprietor. No election was required to be a trader. It's an assessment. You may be in position right now for these benefits. Don't let them lapse. Now let's think about going forward and doing even better with a trading entity. Traders should consider separate legal entities. It has advantages over the Schedule C. Now, if you want a retirement plan benefit for the whole year, you can get it with an entity now through year end. You didn't have to have the entity in place from day one this year. The health insurance portion is only during the entity period. So here are the entity benefits for TTS traders. This is the bullet point list of what's in store as a benefit for you in using a separate legal entity like an LLC. Well, you're going to, business traders, solidify trader tax status. It looks better in an entity versus a Schedule C. We're going to cover each one of these bullet points separately. I'm just going through the list now. You can deduct health insurance and a retirement plan contribution in an S-Corp trading company or C Corp management company. You can't do it as a sole proprietor or as a partnership. You're going to gain flexibility with a 475 election. It's going to work better for you, that election, and it'd be easier to revoke it. You're going to be eligible for the new 20% pass-through deduction on qualified business income, likely including Section 475 income, which requires trader tax status, but clearly expressly excludes capital gains. So if you make $100,000 in your trading business, you might get a $20,000 deduction. There's all sorts of haircuts and limitations. But you might get that with a partnership or an S-Corp. We think you face challenges on that as a sole proprietor. That's a brand new benefit under the new tax cut law that really gave another big incentive to forming an entity. So if you like the entity ideas before that we had, you're going to like them even better now. Now you're going to also avoid wash sale losses with individual and IRA accounts. So you're trading your IRA accounts, you're trading your individual taxable accounts. You got these wash sale headaches. Ring fence in the entity, use 475, it fixes all that mess. Lastly, it gives you some asset protection and business continuity. If you have a joint account, that's continuity, but with an entity, it's nice to have your spouse in there for continuity, but there is some asset protection. It's limited. We'll talk about it. So let's go back to that first bullet point. The trader tax status looks better in an entity. An entity return consolidates trading activity on a pass-through tax return, a partnership form 1065 or S-Corp 1120S, making life easier for you and the IRS. An entity looks better than a Schedule C with losses because trading gains are in other forms. So remember, you look at that 1065. Let's say you have 475 because you want the pass-through deduction. You see revenue up top from 475. You see expenses. You see net income. It's all on that one return. It's a profitable business. It looks great to the IRS. Conversely, as a sole proprietor, you have losses on Schedule C, gains on other forms. The IRS doesn't understand how it's all related and connected. So it just, and they like to go after individuals with 475 losses. They call it Chen cases. You're so much better off with the entity. And it's important to segregate investments from business trading when claiming trader tax status. And an entity is most useful in this regard. So you have portfolio margining, your long tech stocks, the FANG. But you use portfolio margining to manage risk on and off in options on the portfolio. The IRS looks at one program there. The holding periods from the investments are stretched out so you don't qualify for trader tax status because it pollutes the active trading. You want to use 475 on the active trading, and you want deferral on the portfolio so you don't have to pay taxes at year end and you can get a long-term capital gain, but you're giving the IRS a chance to play havoc. You want to ring fence with the entity. It solves all those issues. The entity is better. Now it unlocks the next set of benefits to deduct health insurance premiums and retirement plan contributions. Here's an example. On officer compensation, a TTS S-Corp, because that's how you do it. Trading gains are not earned income. So you're trading in the S-Corp, you pay yourself officer compensation, financial engineering, that creates the earned income. And on that, you may deduct the family health insurance premiums. They could be $20,000, they could be a lot more. And let's say you want to max out a solo 401k retirement plan up to $61,000 in 2018, which includes a $6,000 catch-up provision because you're age 50 or older. So you got total employee benefit plan deductions might be $81,000, which leads to several $1,000s of income tax savings more than payroll tax costs. So you're going to have income tax savings. 81,000 times it could be 40% or what 35%. But you also have offsetting payroll tax costs on your wages of 146,000 or 15.3%. Bottom line, whether you minimize just the elective deferral or you do the profit sharing plan, if you're in a decent tax bracket, if you're in a state that has taxes, and most do, any combination of that, your income tax savings is going to be much greater than your payroll tax cost, putting net money in your pocket. Uncle Sam is paying you to put money aside for retirement, and you can grow those retirement funds tax-free until you take the money out. Now, if you don't have a good year trading and you have a good enough year to do a decent amount of a retirement plan contribution, like the elective deferral, the first $18,500. We'll go over some more particulars later. You can also do a Roth 401k. You don't get a deduction, but that money, the growth of those funds are tax-free for life, and you can pass it to your heirs. Imagine setting aside $24,500 each year and having growth on that be tax-free for life, taking money out in retirement tax-free, passing it to your heirs if you still have some left when you pass away. Anyway, we'll get into more details on that later. But for the deduction of health insurance and a retirement plan, you need to have the S-Corp or the C Corp management company. A sole proprietor or partnership TTS trader cannot have these employee benefit deductions related to trading gains, which are not self-employment income. If you have another consulting business or another source of earned income where your spouse has it, that's a different story. So the takeaway here is that these are powerful deductions. Health insurance has gone up. It's an expensive ticket. You want to deduct it, you need the S-Corp. There's more work with the S-Corp. We have you covered on that. Next, the entity is better for Section 475 elections. That's that powerful tax loss insurance and ticket to get the 20% pass-through deduction. It's good on the downside, which has always been our claim to fame with 475 and TTS. And now with the new tax law, it's also good on the upside, even better. Entities help traders elect 475 later in the tax year, within 75 days of inception. So let's say that, so you don't have to panic to set up an S-Corp tomorrow to elect by March 15th. You can set up the S-Corp next week or April 1st, and then you have 75 days from inception to elect 475. And it's easier for the entity to exit TTS and revoke it than a sole proprietor. The IRS has allowed revocation for sole proprietors. If you have it as an individual and you want to revoke it, you have to do it by this April 15th and then file a 3115. It's just easier with the entity. It's more convenient. The entity adopts 475 internally from inception, as opposed to an existing taxpayer who must prepare and file a complex Form 3115 after filing the external election statement with the IRS. So you're an existing partnership or S-Corp. You elect by March 15th. You're an existing sole proprietor. You elect by April 17th. Next year, when you file your 2018 tax return, you include the Form 3115. Don't mix up the two steps. This is all covered in Green's 2018 Trader Tax Guide. Now, I touched on the ring fencing with the entity. It's just so much better to say, listen, I do investing as an individual. I have retirement accounts, I have investment accounts, but my active trading is ring fenced in an entity where I'm getting all these other benefits too, but ring fencing is clearly one, because when you assess my trader tax status, don't bother to look at my investments and water down my trader tax status. Don't bother trying to play havoc with me. So if you trade and invest in substantially identical positions, example, you trade Apple with 475, and you also invest in Apple for long-term capital gains, it's wise to ring fence trading positions inside an entity account. Without an entity, the IRS could cause havoc. They could recharacterize unrealized or long-term capital gains. They could drag your investments in Apple into 475, so you would lose deferral in the long-term capital gain. Or they could boot your 475 loss into a capital loss. Don't give the IRS a chance to play havoc with you. Use the ring fencing of the entity instead to distinguish your investments versus your trading positions. Now, you can't do portfolio margining across an individual account and your entity account. It's got to be by taxpayer. So that's one thing you may have to give up, or you may not, or you may need to ring fence, but also have investments in the entity account, but be very careful about segregation. These are some of the nuances. I don't want to get you too lost today in the weeds. Just want to touch on the points, and you're going to want to consult with me about it when this comes up for you. Now, next, this new great 20% pass-through deduction. It's brand new, Section 199A. There's a lot of questions that accountants and tax lawyers have for the IRS. And we're waiting for regulations, and a lot of them have to do with this new code section. What's a service business? What's not the service business? What's qualified business income? What's not? I did a bunch of work, and in my opinion, 475 income with trader tax status is likely qualified business income, and 988 4X ordinary income too, but it excludes capital gains. So I think traders can get this 20% pass-through deduction, but only on the 475 and 988 ordinary income. Now, I do think a trading business is a specified service activity, which has a lot more limitations than the non-specified service activities. The code was more intended to manufacturers. Remember my last webinar with IB, we covered the new Tax Act and all this stuff. So go back to that to listen to the recording. So remember, a trading business is a specified service activity. So the individual owner must have taxable income under $315,000 married or $157,500 for other taxpayers. If you go over that, the deduction phases out at $100,000 married or $50,000 other taxpayers. So you come to me on a consult and you say, Bob, my job, I make $250, and from trading, I make another $100, $150, $200, and I'm single. It's pretty clear you're going to be over the $157,500 taxable income, and you're not going to benefit from the pass-through deduction. And if that's your only reason for setting up the entity, we don't need the entity because you have your health insurance and your 401k and your job. So this is where we customize the advice for you. How does the pass-through work? What does that mean? A pass-through entity means the entity is a tax filer. It files a tax return, but it's not a taxpayer. That's why when you go to file your S-Corp extension in 2 days or today, or your partnership extension, it's a simple one-page form. You can e-file it, mail it, call it in, but you got to do it. Otherwise, the penalty could be $200 a month per partner up to 12 months. So get in that extension. It's a simple one. Why is it simple? Because you're not paying taxes with the extension unless there's potentially a minimum tax in your state. So I'm talking about federal. The owners are the taxpayers. That's why you avoid the so-called double taxation of a C Corp, where the C Corp pays taxes on the entity level and then again on the individual level when they pay dividends. So when you set up a pass-through entity, you want to consider what your marital status is, married or single, where your state residence is, the state tax rules, annual reports, minimum taxes, potential franchise taxes, potential excise taxes. In almost all states, it's nil. In some states, it's very minor. It's extremely rare that it's a big problem. But when it is, you just navigate around. Sometimes you need a dual entity solution. It requires a little bit of navigation, but it doesn't disqualify you from getting these benefits. Now, there is no sense in forming your entity in a tax-free state if you live, work, and trade in your home state. And you're passing the income to your home state anyway. So why try to cheat your home state when you're passing the income to it anyway? We'll cover that more later. Let's see how we're doing on time now. Okay, so pass-through Schedule K-1s. You file a pass-through return. You report all your entity trading gains, losses, expenses on the entity tax return, a partnership 1065 or an S-Corp 1120S. Then you issue a Schedule K-1 to each owner for their respective share of each item of income or loss. Make sure to issue that K-1. There's another penalty even for missing that. It's in my blog post. For example, the entity can pass through capital gains to soak up your individual capital loss carryovers, or it can pass through the 475 ordinary income to generate, or losses to generate the tax refunds from the losses or the income for the 20% pass-through deduction. That pass-through deduction is on the individual return. So they go hand in hand, these returns. Don't say, Bob, I don't want to set up an entity. I have to wait to use up my capital loss carryover. Don't worry about that. You don't lose your prior capital loss carryovers on the individual level. They can still carry over on your Schedule D. The new entity can pass through capital gains if you skip the 475 election to use up the capital loss carryovers. And after you use it up, then you can get into 475 in a subsequent year if it's past the deadline. All right. Let's talk about the types of entities. I want you to learn the pros and cons of each type of entity so you can kind of think out what you want to do. Now, if you want to work with me to form the entity, it first requires a 45-minute consultation. I'll assess your trader tax status. I'll assess your need for an entity. I don't want you signing up for the entity formation until that consultation, because I may talk you out of the entity. I only want the entity if there's a super compelling case for it of tax benefits and more that far outweigh the cost and cover the extra complication and time you need to spend with an entity. So let's talk about the types. You've heard the LLCs, corporations, S-Corps, partnerships. Well, your limited liability company, that's the most popular. The default tax treatment for a spousal LLC is a partnership return. If it's a single member LLC, it's a disregarded entity. That's an IRS term. What it means is it's a tax nothing in the eyes of the IRS. So it means the individual owned SMLLC that qualifies for TTS, you're back to filing a Schedule C, which a business trader is trying to avoid. We're setting up the LLC to get away from the Schedule C, unless it's purely for asset protection and on negative balances and the like. But if you're setting it up to get these entity benefits, like the S-Corp, then you want to understand that a multi-member LLC, like a spousal LLC or a single member LLC, both of those LLCs may elect S-Corp tax treatment within 75 days of inception of the entity or by March 15th of the current tax year for existing entities. So if you had a single member LLC last year and it was disregarded, and you want the S-Corp benefits this year, you need to file the Form 2553 S-Corp election by this March 15th in 2 days. Most states accept the federal election. Some states require a separate S-Corp election. So, because again, for a single person, a single member LLC, I recommend the S-Corp election, the SMLC and the S-Corp election. So for the S-Corp election, it's the Form 2553. That's their ticket for the employee benefit plan deductions. If you're single, it's your only ticket to a good entity for the 20% 475 pass-through deduction as well. LLCs and corporations may elect S-Corp status. Traditionally, you would set up a corporation. It would elect the S-Corp status. Most tax attorneys, and we who are not attorneys or CPAs, prefer that you form an LLC, which elects the S-Corp status. Now, understand, a general partnership, which does not have liability protection, it can also elect S-Corp status in every state except Connecticut, District of Columbia, Michigan, New Hampshire, New Jersey, and Tennessee. And again, I want to stress this point a few times in the session. A 2018 S-Corp election is due by March 15, 2018, or within 75 days of inception of a new entity. Don't miss out on that election deadline. Let's go over the S-Corp tax returns for traders, because this is really the home run scenario. This is where you're getting all the benefits, is with the S-Corp tax return. Now, it's a little quirky to arrange the health insurance and retirement plan deductions, and let's go through how to do it. The S-Corp health insurance. Whether the S-Corp is profitable or not, plan to take the officer-owner health insurance deduction through officer W-2 wages. Do the payroll in December for the entire year. You don't have to bother with payroll all 2008. You'll get with us in November, December. You'll run health insurance through the payroll, whether you made money or not in your entity. You'll add the health insurance premiums paid by the entity or individually during the entity period to wages in box 1 on the officer-owner W-2. The health insurance amount in wages is exempt from payroll taxes. There's no FICA, there's no Medicare, there's no workman's compensation, no state unemployment insurance. You plop that $20,000 on the W-2. It's a deduction for the company. The officer deducts health insurance. The company gets a deduction through wages. So the company has a loss of $20,000 from this. You as an individual are deducting the health insurance premium as an adjusted gross income deduction, offsetting the wage component. So you as an individual have a wash. You have the W-2 wages on the one hand coming in, and you have the AGI deduction going out. So that's a wash, but you end up with a net deduction from the company. Quirky, don't want to lose you in the weeds right now. Go back and look at this later. You're going to include health insurance during the short year of the entity. If you form the entity for Q2, you're not getting the Q1 health insurance. And you're only doing this for individual health insurance, that's so-called self-employed health insurance. You're excluding employer-provided insurance, including COBRA, for you or your spouse. That doesn't qualify. So when you assess whether you should keep COBRA or not, understand COBRA can't deduct. Individual health insurance can deduct. Is it worth going off of COBRA for that? You may love your COBRA and want to stick with it because it's a great plan. It's usually not cheap, but it could be a great plan. Next, the solo 401k retirement plan, elective deferral first. That's where the biggest tax juice is because it's 100% deductible. You got wages at $24,500, you deduct $24,500. It's a beautiful income versus deduction, and that's where the most savings is. But we only want you to do it if you have sufficient trading profits by Q4. We don't want to do this earlier in the year because you may have a bad Q3 and Q4. That's when you consider establishing your solo 401k plan before year end. So you're going to start with 100% deductible elective deferral. And as I'm going through this, there's a lot of weeds here, and I hope I'm not losing any of you here. You can go back and look at the slides too, and I may jump ahead a bit because it sounds a little technical here. Bottom line is you're doing the elective deferral. That's where the biggest tax use is. You're doing it with your payroll at year end. You're working with your accountant on that. There is offsetting payroll tax, but the 100% deductible income tax savings is much greater than the payroll. If you have a great year, you're going to beef up the wages. You'll say, Bob, I made $200, $300. Let's go for the wages of $146 so I can have the 25% deductible profit sharing plan of $36,500 for additional savings. Going for the whole grand kahuna of $61,000. You do all that with the S-Corp. The profit sharing portion you have until the next year to pay by the due date of the return. And you're going to need to set up the payroll compliance in December. And we'll have a year-end planning webinar about that. Go back and read these slides later. There's no offsetting unemployment insurance or workman's comp in almost all states. It's pretty simple. There's a payroll vendor. You pay them $600. They do all this stuff. It's very easy. Now you also need an accountable plan. The S-Corp is a little bit more formal. You're going to use it or lose it. So this is like what you had in your job. You give the expenses to the employer. You say, hey, reimburse me for these. You better do that, by the way, because the new Tax Act suspended miscellaneous itemized deductions, including unreimbursed employee business expenses. So with the S-Corp, you got the accountable plan. You submit your expenses, including the home office, before year end. Not a big deal. We provide you this plan in our entity service. The partnership tax returns are more flexible. They let you have special allocations, which can come in handy. S-Corps don't. But you're not going to achieve all these employee benefit plan deductions with the partnership. So it's an easier return, but you're not getting the health insurance and the retirement plan deductions. It's difficult to arrange employee benefit plans in a trading partnership. And let me just check on the timing here before we, 1 second here. Take a quick break. Good, 12:39, we're doing pretty good. Some of this stuff I'm jumping through a little bit because, 1 second. Just 1 second, please. I was connected on my iPhone next to my computer to see the screen. I just want to get it rejoined. Okay, I'm back. All right, so it's difficult to arrange employee benefit plans in trading partnerships. If you trade in a general partnership or multi-member LLC filing a partnership return, it's difficult to achieve targeted SEI for health insurance and retirement plan deductions. This is the reason here. The partnership passes through the negative self-employment income, whereas the S-Corp does not. It's a technical thing. Even a lot of accountants don't understand it. They think the partnership can just issue a guaranteed payment that can give the taxpayer the earned income they need for these deductions. It cannot. Go back and read our content on that. It's not going to work. You need the S-Corp with the wages. That's all you need to know. Don't get caught up in the weeds. Now, an LLC partnership can elect the S-Corp status by March 15th. So if you've had the partnership return on your spousal LLC, consider the election by this March 15th if you want those benefits. If you're leaving a job now and you know you're going to have expensive health insurance and want to deduct it and no longer have a 401k in your job, you want the S-Corp. Now, one nice thing the partnership has is special allocations. So a father and son, mother, daughter, parent puts up most of the capital. The child trader wants to get a special allocation of trading gains because they're not putting up much capital. That's a special allocation. That's what investment managers do with hedge funds. Only partnerships can have special allocations. S-Corps cannot. So if you want the so-called carried interest benefits, you need the partnership. You might have both. You might have a trading partnership with special allocations and an S-Corp management company with the employee benefit plan deductions. Sky's the limit. We can design a plan for your needs, but you just need to understand the various concepts. So again, the IRS does not allow partnerships to pay wages to partners. They're supposed to use guaranteed payments, but when you pay the guaranteed payment in a trading company with trader tax status, you're going to be passing through the negative expense of that. The trading gains will not give, with 475, will not give you the income you need for SEI because trading income is not SEI. Again, technical, but you just need to understand the bottom line. Now, another nice thing about the partnership is the unreimbursed partnership expenses. You don't need that accountable plan. You can have two partners in a partnership, both traders, sort of like a prop trading firm, and they say, listen, the partnership is going to pay our basic expenses, but we're each going to pay our respective home office. We're each going to pay our respective computers. You want to travel to seminars? I don't. You want to be more aggressive with meals? I don't. And you can run it that way with unreimbursed partnership expenses. It really works out quite nicely. You can't do that with the S-Corp. So if you're like a prop trading firm, a couple of people, 3, 4 people trading together, sharing some expenses, but not all, the partnership structure works nicely for you because you don't need those employee benefit plan deductions. That's not your focus. You want the 475 pass-through deduction. You want the unreimbursed partnership expense benefits. You want to look better than the Schedule C. You want all that. You want the carried interest. Partnership works great for you. So one size doesn't fit all. Now, with the new tax law, there's also the possibility that you may want to have a C Corp that's eligible for trader tax status. If you live in one of the 6 states without a corporate tax, like Texas or Washington State, and you're in the top individual income tax bracket, a C Corp could be useful to you under the new tax law in very limited circumstances. So you're probably not going to benefit from a C Corp. But again, if you met those limited criteria I just laid out, it might be for you. So when you take into account the Tax Cuts and Jobs Act for 2018, don't focus solely on the federal 21% flat tax rate. We all heard that. Oh, they lowered the federal rate on C Corps to 21% from 35%. Wow, let's all go for that. No. By the way, it used to be the first 50,000, the rate was 15%. For those people, it was a tax hike. Some traders might not make more than that, especially after they take a salary and have a retirement plan deduction. It's a tax hike. Plus, it's a flat rate. It's not an average rate compared to your individual rates. You may not be in a high bracket. Your effective tax rate may not be much higher than the 21%. And there are plenty of other taxes to consider, including capital gains taxes on qualified dividends. You might pay another 15%. Your state may have a corporate tax. In 44 states, it does. And then the IRS may hit you with a 20% accumulated earnings tax. C Corp and related taxes might be considerably higher versus trading in a pass-through. You need to crunch the numbers. If you're not making a lot of money, your tax rates are not that high versus the C Corp. And you might get that pass-through deduction. So that's probably the way to go. But if you're not getting the pass-through deduction because you're in a super high rate and you are in a tax-free state for corporate like Washington or Texas, and you have a war chest plan for why you want to retain earnings, it could work. So keep in mind the double taxation. When a C Corp pays qualified dividends to the owner, double taxation occurs with capital gains taxes on the individual level. So you made money in your C Corp, you paid your 21% rate. Now you pay a dividend to yourself and have to pay another 15%. So you're back to that highest individual rate when you total it all up. So that savings all of a sudden started to disappear. Now let's say, okay, you say, I'm not paying my qualified dividend, Bob. I want to retain the earnings in the entity. I'm not in a rush for this money. I have a job. My spouse has a job. I'm going to leave the money in the C Corp and just pay the 21%. I'm not going to pay the qualified dividend. This is where the IRS comes in with a whole other set of rules to force you into some taxes. They are entitled to assess a 20% accumulated earnings tax on retained earnings over $250,000 unless the owner has a believable war chest plan for spending those additional retained earnings in the near future. Let's say you say, Bob, I'm creating algorithms, bots, I'm hiring engineers, I'm buying more computers, HFT. I want to grow the business and I need more money to do so. I have a war chest plan. I can satisfy that IRS rule. Great. And it has to be believable and you have to execute it. Most at-home traders don't have a war chest plan. You can't just say, I want more capital to have access to lower commissions, to have access to more markets. The IRS won't agree to that being part of a war chest plan. So that's really the missing link. If you're going to get hit with that 20% AET, skip the C Corp. And if your state double taxation is high, like in California with 8.84%, or in New York State, skip the C Corp. So most of you, if you're trading on your own, you got health insurance, you want a retirement plan, you want a pass-through deduction, you want the 475 election, you're trading securities, you're going to go for the home run and go for the S-Corp unless you're in a place that taxes S-Corps and you need a dual entity and maybe you're not sure you want that. You're going to go that route. If you peel away the onion and say, Bob, I don't need the employee benefits, but there's still a lot of reasons why I want the partnership, including for the pass-through deduction, then we'll go that route. If you happen to qualify for that very limited situation of the C Corp being for you, then maybe we go with a C Corp. And then to fill in the blanks, maybe we have a little bit of both with a trading partnership and a C Corp or S-Corp management company. It can take any one of those directions when you boil down what's best for you. Now, again, you want to form the entity in your home state. Forming a pass-through entity in a tax-free state doesn't avoid IRS, doesn't avoid individual taxes in your home state. We touched on this before. Tax-free states market entities for asset protection. There's a lot of salesmen in Nevada. Oh, set up in Nevada, set up a mail forwarding. You won't have to pay tax in California. If you get sued, you have asset protection. Well, both of those asset protection and tax avoidance reasons fail unless you register in your home state. If you live and work in your home state, you need to register a foreign entity in that state. If that's where you're operating it from, having just a mail forwarding address in Nevada is not nexus. So registering is a must. Asset protection won't work in your home state. If you get sued in California and you have a Nevada LLC, how's that LLC going to help you in California if you haven't registered it in California? And that's where you're going to get sued. That's where you're doing business. So with a pass-through entity, again, you're passing it to your home state anyway. With a C Corp, they're going to say it's doing business in California. And then you're going to get hit with an 8.84% corporate tax. Costs for setting up a trading business. There are a few reasonable costs and or taxes for setting up a trading business, and it takes about a week. Sole proprietorship or general partnership is very simple. There are no state filing fees, annual reports, or minimum taxes. I mean, in a couple of states, there might be a small tax for a Schedule C, like a filing, like in Connecticut, my home state, every 2 years you pay $250. The LLC or C Corps, they have entity filing fees. They vary by state. A lot of states are around $100. In just a couple, it's much higher, like closer to $500, like Massachusetts, Illinois. The S-Corp minimum taxes are extremely low or non-existent in most states. California is one that stands out where it's really high, $800. Annual reports are usually $50. If you do it online, it's $10. That S-Corp minimum tax is like kind of a minimum franchise tax for the S-Corp. And in a couple of states, there are excise taxes. But when you read the website, and I looked at a lot of states all around the country, you say, oh, there's an excise tax, 6%. But then when you look at it, you realize that there's an exemption for a trading company or an investment partnership. In most states, investment partnerships, including trading companies with trader tax status, are exempt from excise taxes or Illinois replacement taxes. The investment partnership is exempt, the S-Corp is not. So when you find that, there is a small tax on the S-Corp, but for me it could be big because I'm trading millions of dollars, then we might think of a dual entity solution with a trading partnership. Rare situations like that. California is one. They have the S-Corp franchise tax of 1.5%. If you're making over $300,000 a year, we might want the dual entity solution. We offer an entity formation service. You start with the consult with me for 45 minutes. Do you qualify for trader tax status? Do you need an entity? How will it help you? What are the costs? What are the benefits? What's the best solution? What should we do and where and when? Then you upgrade to the entity formation service and we do it. The whole thing, the consult, the entity formation, the filing fees, everything, it costs usually under $1,000. IB will have an entity account for you, get with those same great low commissions, but there are professional data feed fees on an entity account, whereas an individual might have the non-pro rates, which are lower. So check with IB about that. Now, I think we do have more time, so let's take a look at some of the other slides. Business expenses. Remember before I said trader tax status is great, it gives you business expenses. You could do this as a sole proprietor, a partnership, an S-Corp, a C Corp. You don't have trader tax status, you don't get any business expenses. You don't get any investment expenses. So if you qualify, you get these expenses. Tangible personal property like a computer up to $2,500 per item. Section 179, 100% bonus or regular depreciation on computers, equipment, furniture, and fixtures. The new Tax Act really improved first-year expensing. You buy it, you write it off. You're going to amortize startup costs, organization costs, education expenses paid after commencement of TTS is fully deductible. If it was pre-business, you can slip it into Section 195 startup to write it off, expensing up to $5,000. Books, publications, market data, online, professional services, chat rooms, mentors, coaches, supplies, phone, travel. They did knock out entertainment for the most part in the new tax law. Seminars, conferences, assistants, consultants, and more. All that's deductible. The only thing I took off this list was entertainment. Home office expenses for the business portion of your home. This is a great way to get some more of that SALT. The SALT is capped at $10K as an itemized deduction. It doesn't cap the mortgage interest and real estate tax portion of the home office deduction. You get it more there. Your margin interest, business deduction. Your stock borrow fees as a short seller. Your exposure fees on high-risk positions. Your internal use software. All a business deduction from automated trading. You really want this TTS. You want it presented properly on an entity return. Now, don't go for your car, your vehicle, because most at-home traders don't need that. And don't worry about the brokerage commissions. Those are not separately stated. That's part of your trading gain or loss. So what's your ticket to all these benefits? Trader tax status, you need to qualify. It's not easy. Learn my golden rules based on the court cases. So the case law says, hey, no statutory law. Trading must be substantial, regular, frequent, and continuous. The taxpayer must seek to catch the swings in daily market movements and profit from these short-term changes rather than profiting from long-term holding of investments. Great. A lot of you think you satisfy that, but that's not enough. We think you need more of a bright line test. So our golden rules are sort of like bright line test, only they're not a bright line test. So we've because you need numbers to do a better assessment. So we're looking for substantial volume of trades. The IRS can see how many trades did you make, how frequent were they, what was the holding period. They can't see as much what kind of work you put into it, what your intention was. These are the numbers that they can prove out. So the Pope Court was a nice court case, and it's recent. And it seemed to capture all the prior cases well. And I think it's sort of like can be used as a bright line test. But again, it's not officially a bright line test. So the Pope Court said four trades a day, well, more or less said 15 trades a week, 60 a month, 720 a year annualized. So if you start Q4, you're starting the 60 a month in Q4. The 720 is only for a full year annualized, counting the buy and sell separately, the open and close separately. You put on a trade, the broker breaks it down to 10 trades, you just count the one trade. You put on a complex options trade with 4 legs. If you put on the 4 legs separately, you count the 4 legs separately. If you just hit a button and the broker breaks down the 4 legs for you, don't count them. This has not come up in tax court yet. We're using common sense here. Usually traders have substantial proceeds, but that's a hard number to quantify. You got to do it regularly, frequent. We have a number for frequency. We want to see 75%, close to 4 days a week. A lot of tax court cases had 2 days a week, close to 3 days a week. They had 40, 45, 50%. We want a comfortable margin of 75%. Continuous, no sporadic lapses. You don't trade for a month, take off for a month. It's continuous. I want to see 4 hours a day, including research and administration. Now, it's daily market movements that you're looking for. The average holding period needs to be under 31 days. That's the one bright line test that came out of the Endicott court case. It's disqualifying otherwise. You could hit every other golden rule. If your average holding period is over 31 days, you're disqualified for trader tax status. If that happens because you've polluted your trading with investing and they've looked at the investing and it's dragged out the holding period, that's where you got to ring fence with the entity to get back to a shorter holding period. That's where you may want to put on a few more trades and a few shorter trades, but don't have the tax tail wag the dog. But if you feel you can do it with risk, not with bogus tiny positions, you can't just hit the button on your computer for extra trades. They have to be real trades. Think about this carefully. Your intention needs to be to run a business to make a living. It can be a supplemental living to your job. You should have a trader setup, a rock solid business setup, a powerful trading device, computer, multiple monitors, iPad, iPhone. Traders usually have really impressive setups, and they have a dedicated home office, and it's got to be a material account size. You need 25,000 to be a patent day trader in securities. If you're futures or trading other instruments, I want to see at least 15, and it should be material to your net worth. If you're a multimillionaire, 15 is not going to cut the mustard with the IRS. What doesn't qualify for trader tax status? Again, this is if you don't have a rock solid trader tax status concrete foundation, you're not going to bother building a trader tax status house with an LLC, and then at year end doing the payroll and the retirement plan. It's all going to backfire on you. The foundation is going to crack, and the house is going to come crumbling down. So when you come to us in December for executing the payroll to basically cash in on all these benefits, we're going to look over the trader tax status again. And if you don't have it, we're not going to do it, because we know the house is going to crash and crumble, come tumbling down. So understand what doesn't qualify. Automated trading without much involvement by the trader. When you tell us you have a really high number of trades and you don't have a lot of time in, we suspect it's automated. Well, you tell us up front it's automated. If you license the automation from a third party and you're not a computer programmer and you don't really know how to set up an automated trading system, and all you're doing is really picking and choosing some signals and what system, asset allocation, you're not flying the plane. You got to fly the plane with automation and manual. You can't be a passenger. If it's automation without involvement, that's sufficient. It doesn't qualify. So you might have involvement in manual trading, but also have an automated program, and the cost of the automation may not be a business deduction. It's sort of like segregation of investment. Now, also, if you engage an outside investment manager, well, you're not making the trading decisions, the manager is. If your broker makes all your decisions, it's usually an investment manager. And now, trading in retirement funds, that's not trader tax status. You may do active trading, but that's not trader tax status. So understand what doesn't qualify. So if your passion is trading, then consider a trading business structure with maximum tax advantages customized for your specific needs. So good, we're at 103, we got in all the slides. We're going to get to your questions now. I did jump ahead through the weeds on that, how to do the S-Corp, health insurance, and retirement plan. Go back and look at that later. You have plenty of time to deal with that when you deal with your year-end tax planning at the end of 2018. So stay with us. We're getting to some great questions here, but I just kind of want to go through a few closing remarks first for those who don't want to stick around for the questions. Thank you for coming today. Go over to GreenTraderTax.com, read all those recent blog posts about the entity extensions, the individual extensions, the 475 elections. The ones before that are all about the new tax law and planning. Pick up a copy of the guide. It's a great price. It's good. Could be a business deduction for you with trader tax status. It's going to save you a lot of money. It delves into all this a lot more. There's a whole chapter on entities. All of this is in the guide. If I don't get to your questions today, or if you want more answers, email us at info@greentradertax.com. Give us a call, 888-558-5257. Now, if you call, if you chat, Julie may not field you today. We are really busy with the entity extensions March 15th, individual extensions April 17th. We are still accepting new clients, but we're doing extensions only. We have a process for it. We're very careful about quality control. There's a good fit evaluation. Check all that out on our website. But you can do a consult with me. I'm not doing the tax returns. I can do the consult for the entity. I can form your entity. You can get on my calendar usually within a week. I have been booked rock solid, but you can get on within a week. So let's take a look at the questions. This is the website. We're going to get to your questions now. So by the way, on the website, before I go to the questions, under the Tax Center, you can go to Entity Solutions, and under Services, you can go to Entity Formation Services and check all that out. All right, let's get to questions. Let me just drink something. So I'm going to try to get to one question per person, and we're not going to go too long. But let's see the questions now. It's not for Canadians. Michael B., what is the deadline for LLC? If you have an existing LLC and want an S-Corp election, it's by March 15th. If you want to form a new entity this week, you'll have 75 days from inception to elect S-Corp status and to elect 475 internally. So there's plenty of time for the new entity, no rush. Sean, we're happy to talk to you about setting up the business soon. For new corps that are yet to be formed, can 475 be filed at the same time of formation? Yes. That's just what I said. You don't have to. The deadline is only for existing entities, for existing individuals. For new entities, we have 75 days from inception, plenty of time, and we cover all of that as part of our entity formation service. Alexander A., I have a few, well, I have elected 475 for 018 from 2017. I had a number of deferred losses. Yeah, so if you have a wash sale loss deferral with trader tax status at the end of 017 and you elect 475 as an individual for 2018, you can convert those wash sales to ordinary losses on January 1st. That's a wonderful solution, but it does require using trader tax status for 2017. So don't rush in your return, get it wrong, file an extension, and attach the 475 election. So read my blog post. Consider a consult with me if you can't get to me by then, because if I get too filled up over the coming weeks, read the blog post. The guide goes through all of those example scenarios. The whole chapter 2 is on 475. AJ, you can't do a 475 as a cryptocurrency trader, correct? I have a brand new post just on that. It's going to also be on CoinDesk, and it's going to publish probably later today, tomorrow. My editor just sent me back the comments this morning. So when I get to that, it will be up. I argue that 475 does not apply to coin, but it applies to Bitcoin futures and the Bitcoin investment trust securities, but not the coin. And AA had a second question. I'll jump to EN. If I have an S-Corp trading company started in 2017 with a timely election 475, did it have enough capital to justify? Okay, so if you made an election for 2000 from inception for 2017, but you didn't qualify for trader tax status and you couldn't use the 475, you should re-elect it externally by this March 15 to play it safe, because the original election was null and void. I think that was your full question. It went on, EN. DG. Bob, what is your basis for saying that TTS is eligible for the new pass-through deduction? I have a whole blog on that, 2 of them. If you saw my play-by-play as they negotiated these tax reform, I have several blog posts arguing that 475 income is ordinary income. It's business in a business. That's what the pass-through deduction is for. The pass-through deduction excludes capital gains. 475 is not. Go back and read my blog posts on that. I put a lot of time and effort into it. I consulted some leading professionals on it, including Stephen Rosenthal, Roger Lawrence, others. So read the blog post. But notice that in all my content, I say QBI, qualified business income, likely includes 475, but excludes capital gains. I use the word likely. Until I see in IRS regulations specifically on point giving a green light, I am more comfortable saying likely. Now, would I set up an S-Corp and go through all the trouble of that just for this deduction? Maybe not. I would do it for the cake, the pass-through, the employee benefit plan deductions. That's the cake. I view the 20% deduction as icing on the cake because, number one, you may make too much income to get it. Number two, the IRS could reverse something here. This is a brand new code section. So I've been very careful with my wording on all fronts, in every consultation, in every memo, in every content. Good question. MR. Does one have to register a sole prop? No. Or is one automatically an individual trader? Yes. You claim trader tax status after the fact, but you have to elect 475 on time. They're related but different. TTS is undergraduate school. You then have to apply to grad school, which is 475. If you never graduate undergraduate school, you never qualify for TTS, you can't go to grad school, even though you filed the election on time. That's the analogy I use. BD. If you make a TTS election, and you mean a 475 election, do you lose your capital loss carryovers? No, remember I covered that twice. I was redundant on that in the content. You got your capital loss carryovers, you set up your new entity. You're saying, okay, I got 75 days to elect 475 in my new entity. If I have capital gains, I'll skip it because I want to pass through capital gains to my individual return to soak up the capital loss carryover. If I have a big new loss, I'm going to elect it so I don't add to the capital loss carryover. I walk you through all the decision-making rationale in the blog post on 475 and in the guide, Chapter 2. Jason C. Can a person qualify for TTS using managed futures? No, you're not flying the plane. The outside investment advisor, the commodity trading advisor, is flying the plane. Tony C. I do trade options and stocks. Do cryptocurrency trading also count? Everything you trade can be part of trader tax status. So when you're looking for your 720 trades, you have 1,000. You have 250 trades in securities, 250 trades in options, 250 trades in futures, 250 trades in coin, and you're active on all fronts. Maybe you can count it all together for the TTS, but you make a 475 election on securities. You don't make it on commodities, which include 1256, so you can retain the lower 60/40 rates on that, and none of this affected your coin, which is capital gain or loss. So a lot of these concepts you can mix and match, and you and your local accountant can get severely mixed up. So you need to read the content, consider a consult. Remember, we run the business the way we do. I focus on the content and the consults and the entities so that my partners, Darren Neuschwander and Anna Manning, can run the compliance practice, which is our core business. And they're really busy with all the clients getting tax returns done, but I'm not on that production line. So I have time to help you through these deadlines. NS, is the 475 election for stock trading only? No, it's for securities and or commodities. Commodities including 1256 contracts. Let's say you trade futures. You want to retain the lower 60/40 rates. You don't want a 475 election with ordinary income. You want 60/40, 60% long-term capital gains. But you've gone ahead and lost 100,000 in Q1, and you're going to stop trading, and you have trader tax status from last year and Q1 this year, and you don't have a 1256 loss carryback opportunity. So go ahead and elect 475 to get an ordinary loss to offset your wages. Again, every concept has to be applied in a customized manner. Otherwise, you can make a tragic error. And if you call your local CPA who's so busy preparing tax returns, who is gracious enough to take your call, and you ask him these questions, they're going to not know what you're talking about. And they're going to say, well, I don't even know if you qualify as a trader, and I don't know if 475 is right. And you're going to miss the boat. And then you're going to pay the price later. So read the guide and consider the consult with me. But the guide may have all the answers you need. JK. How do you adopt internally 475? And then you don't file a 3115. You form the entity. We give you a resolution to adopt 475 internally. It's all explained in the guide and in the blog post. You file the resolution in your books and records. That's it. You're adopting 475 from inception. You're not changing your accounting method, so there's no 3115. It's a nice convenience with the entity. That's in the PowerPoint presentation. Go back and look at it. SM. If one opens a sole prop, does it have to be a separate company? Yeah, you want to keep it separate from your consulting business. You can have 1, 2, 3, 4 Schedule Cs. They're all combined for SEI purposes, self-employment income and SE tax. Or you're meeting, and the 475 is just for that trading business. RS. Will you send out recording? IB will have it on their site, and we'll have a link from our site. I see a lot of multiple questions. DG. Can I convert my individual account to business account? No. You can't just tell IB, oh, take this account and change the name to the business. You have to open up a new entity account. GP. Do you have a flow chart of these choices? No, I was just thinking to put on a, not so much a flow chart, but kind of a table. I might work something up like that showing, but maybe a flow chart too. Good suggestion, GP. DG, is the new 20% pass-through allowed for financial advisors? Yes, as long as your business has qualified business income domestic, not exports. Like you're an investment advisor. Yes, but if it's a service business, that's where you're limited. If you make over the 315K, you're limited, and over 415K married, it completely phases out. 157.5K plus 50K phase out for other taxpayers who are not married. So if it's a service business, you hit those thresholds, it's over. You're a non-service business, you can keep going. You can still get a deduction, but it's limited to the wage factor. So there's got to be wages in that business. So sure, everybody wants to know what's service and what's not, and it gets very confusing, and that's all not settled law. This tax law was done in haste. There's a lot of cleanup that needs to be done. JT. If you are trading as an individual in an account where you hold investments and trade futures, since the futures activity is generated by the broker, is this sufficient ring fence? No. You want to set up an entity and trade yourself. Anything that someone else trades, you can't claim for trader tax status. So you want a ring fence. JC. Can I have a, and I'm not sure if you had asked the question. I think you did, JC. MR. How does a new pass-through deduction affect traders using 1256? You're not going to, you probably are better off with 60/40 than making a 475 election to give up 60/40 and maybe have regulations come out a year from now saying that no, it's not included. So I want you to stick with 60/40 and not make the 475 election just for the pass-through deduction. You're probably going to get more from 60/40 anyway. TB. I have to drop off, but a question, well, if you drop, then you're not here. TJP. Is there an age limit? No, solo 401k? No. MS. Do your fees include help with audit occurs? We do everything hourly by form on the tax compliance. We defend returns to the bitter end. We never give up. If there's a position that's not strong, we do not take it. We do not play games with the IRS. We call the balls and strikes the way they see them. That's why we have great credibility with the IRS. But if there is a protracted problem with the IRS, we defend you to the end, but we charge our hourly fees, our tax attorney fees. If you get audit protection from a tax storefront, first of all, they don't know trader tax status in 475, so there's a whole heap of problems. Their audit protection is just for their software that it worked properly, not for dealing with all these issues. So it's an empty promise. It's an empty guarantee. And they don't even know how to fix, or because you missed the boat on it all anyway. Don't fall for an empty guarantee from a provider who does not know any of this stuff. It's not going to do you any good. Any kind of come-on strategy, it's usually too good to be true. Mark S. Is there differences, recommendations for investment advisors, CTA business? Yes, a world of difference. Investment advisors have underlying earned income as a sole proprietor. They use S-Corps to actually reduce payroll taxes. But if you're making a boatload, you may not need that. So a lot of our strategies are turned upside down. So it is very different for investment advisors. That's beyond the scope of today's content. And that is in my guide. I have a whole chapter on investment managers, and I do explain all the entity strategies, including the new law for investment advisors. And I cover carried interest and the like. Mike M. He said he's been losing. Okay, you still may want your business deductions to offset your other. If you're a losing trader, you want your business deductions, you want your 475 tax loss insurance, you want to be a tax shelter for your spouse. You don't want to have no business deductions, no loss deductions, and just be a further drain on the family. You want to be a tax shelter for the family, so you bring in the refunds and replenish your trading account with that. You want to add your share. J.A. How to qualify. Jay, you had that question at 12:56. You saw right after that, I showed you how. So it looks like a WH. We're almost done with the questions, Cynthia, because I'm almost done with the first round. So I'm still going, I think, okay here. I know we talked about maybe a hard break at 1:30. WH. Can I use a consult for non-trading? Yeah, you can. I can talk to you about setting up another type of business, but our entity formation service is only for retail businesses. We don't set up investment advisors. We don't set up other types of businesses because you might need a state license. There might be other state issues, sales tax, which our tax team will deal with, of course, for tax compliance. But we don't want to be responsible for setting up your entity with our outside attorney who does all the quick paperwork for a retail trading business. We're not a law firm. We set up the entity, and our outside attorney that you pay for directly is the law firm that does all the paperwork, providing the legal service. Read about that on the entity page. DM. Auto trades, I covered that, DM. RO. Foreign advisor, that's outside of the wheelhouse here. IP, does automated trading entity qualify? Yeah, if it's self-created. A lot of traders, a lot of our clients have software engineering type backgrounds. They are creating algorithms, bots, automated trading. They're getting credit for it. Yes, IP, you can have a solo 401k with a qualified retirement plan loan. You can borrow up to $50,000 or 50% of plan assets to the lower of, pay it back over 5 years on a quarterly basis with a market rate of interest. That's all covered in the guide. RJ, quant trading, I just covered that. It's the automated trading. RJ, that was yours. I'm sorry. WR, for that was, okay, WR was Forex. Hear a lot less about Forex these days, a lot more about cryptocurrency. A lot of Forex traders have trader tax status. We've been handling the Forex from day one. You don't talk about 475 for Forex. The big thing with Forex is making the internal capital gains election on a contemporaneous basis, on a good to cancel basis for the year. There is no deadline. Once you make the election, it's going forward. We show you how to navigate on the majors only, not the minors, into the lower 60/40 tax rates of Section 1256G. That's a real mouthful. Go to the website, click on the tax center, click on financial products, click on Forex, read all the posts and content about that. It's in the guide. We've been a leader on Forex tax for decades now. GM, any specific comments about state of Illinois S-Corps? Yeah, they got the 1.5% replacement tax on S-Corps. The partnership, investment partnership exemption does not apply to the S-Corps. So if you make a lot of money in Illinois, we recommend the dual entity solution. So you have a trading partnership exempt from the replacement tax, the S-Corp management company for all the employee benefit plan deductions. Then it has a small net income and a tiny replacement tax. Tim, we practice in every state. We know every state right down the line. is our clients are in the population centers right down the line. So you can expect when you work with us that we know your state for setting up the entity, for consulting you, and for your tax compliance. TP, I think you had a question already. Again, you'll see all the slides. JP, TTS, a fit with Bitcoin. Yeah, you can. The whole new blog is about how cryptocurrency traders can use TTS. Look for that blog tonight or tomorrow, and then on CoinDesk. SN, can I combine? Not with like Airbnb. No, I want trading ring fence, trading pure. As soon as you put other stuff in there, you give the IRS a chance to undermine your trader tax status. Or KM about futures. You'll learn more about futures on the site and in the guide. I'm going to try to wrap up here, staying on point about the entities, KM. TH, minimum 15K options and futures, that's okay. AI, AL, house structure, RIA, so client deduct carried interest. Clients are not, so the way the carried interest works, go back to my last post, I covered that. Your clients can't deduct investment expenses. So in a hedge fund, they have less capital gains. But if you're doing managed accounts, you can't do that. Okay, just about wrapping up here. Let's see, we're just about closing out. JS, if you had an automated programmer working for you, if you're a trader and you're a manual trader and you're clear that you got the pedigree, and you also happen to hire a programmer who's working under your instructions and supervision, who's really doing what you say to create the automation, it's just that you don't know how to code, that might qualify. There's a fine line on everything. And when you navigate the fine line, you want me in your corner calling the balls and strikes. I have the judgment, experience, and history to do it, and credibility to do it. And I call it like it is. You don't want to find out you're in trouble from the IRS. You want to find out you face trouble from me so we can navigate around it or skip it because you're barking up the wrong tree. So I don't play audit lottery games. I call it like it is. And that's what our clients want. That's why you're coming to me. You don't go to a doctor for him to know you're sick and not tell you you're sick, and not to tell you how to get better and give you a good treatment and a great strategy. RM, sorry if I had too many analogies today. ML, a C Corp would be better to have a vice. I'm not sure what you mean by that. But let me start to wrap up now. I see there are more questions on the board. A lot of great questions. Wow, I see another 100 questions. The way I usually do this is I do wrap up, but then for like another 15 or 30 minutes, I look at my email. So just bring on those questions now. Just cut and paste them from what you put down. Send them over to info@, I'm going to type it up on the board now. I don't know if you can see it actually, because I don't think you see the questions. info@greentradertax.com. Remember, you're on the website there. You can just go to contact us and send over a question. Keep it short and sweet. The way I handle questions is I give you a quick little taste of an answer and usually recommend the consult as well, or the guide, or point you to a blog post on the website. So Cynthia, thank you to everyone at Interactive Brokers. I really enjoyed doing another webinar with your team. It's been a nice relationship that we have working here, where we're kind of doing our webinars that we conceive at Interactive Brokers because our firms match up so well. We both cater to really active traders, the types of traders that want to set up businesses, make a lot of money, when they lose, want to deduct it, and want to take advantage of every benefit possible. So thank you all, and I look forward to working with you soon.
Well, Robert, I want to thank you very much for today's information, and also remind everyone that we have been recording today's event, and each of you will get a direct link to today's recorded playback, as well as a link to the slides that Robert has been using today. So if you do want to come back and review those concepts, simply watch your email shortly, and I will be providing you with those direct links. So they are coming. Now, also, what I'm going to do, Robert, is is grab the presenter roll back, because I did want to show folks how to access the information, not only today's recording, but also any of your previous recordings that you've done with Interactive Brokers. From the Interactive Broker website, simply go to the Education menu and you'll find a webinars link is included here. Once you open that link, I do want to point out there is a search field that's available, and simply enter Robert's name into that field and you'll find all of his previous events with a direct link to the recorded playback, and then also you'll find that we do include the webinar notes will be available from this screen as well. So I did want to point that out. Now also for the follow-up message today, be aware that I'll be sending you a direct link to the recorded playback as well as access to our webinar archives. Now, from the link I provide in the follow-up message, you'll see that it'll take you directly to the industry-sponsored tab, where once again you can look up by speaker. Notice here I'll simply go into the show all and we'll scroll down and find Robert Green's name, and here once again is where you can find all of that information. So do be watching for our follow-up email. Click on the link that will give you access to our archives, and you can come in and review any of Robert's previous events. And also keep in mind the webinar notes here will include those slides. So with that, we are going to wrap up today's event. A great deal of thanks to Robert Green of GreenTraderTax.com, where you can find out some additional information. I'm going to also pull up the webinar slides for today's event and leave this as you exit. By the way, for any of those contact information or the contact that Robert has provided, you can actually put let me move that up. There we have it. You can put that information or find it within the webinar notes today. So thanks as well to all of you for participating with our session here today. You can exit the event using the X in the upper right-hand corner of your screen. So thank you once again, and have a great rest of your day all.